This is Carrie Sparks with Pioneer Title, coming to you from the old Pueblo today. I'm down in Tucson meeting with some of my escrow officers, my customers. I've got a development down here in Tucson that I work with. I'm really proud of that. And I just want to say thank you to everyone who has stuck with me, stuck with Pioneer, my teams during this whole COVID-19. And now that we're starting to see the end of this, hopefully, at least we're changing back to I hate new normal, but going to see it through different lenses business right now. But I'm going to continue my classes streaming live on Facebook. Please remember they're all being hosted up on my YouTube channel and trying to provide value. If there's something out there that you'd like to know more about as it relates to real estate, please give me a call at 602-715-5704 and let me know what you want to know more about. Today, I am going to be here with Andrew Bang from Boomerang Capital in Mesa. Anyone who's heard me talk about Andrew knows, and you know too, Andrew, I brag about this guy all the time. I think you're incredibly talented. You are the human calculator, hashtag human calculator. And so he's going to talk about investing. And I want you to just kind of talk a little bit about yourself and maybe give your contact information at the beginning here. But I really want to start before your presentation in talking about the rental or the investor market, talk a little bit about Airbnbs, VRBOs, and what you're seeing, because what you're seeing, what we were talking about before we went live, is very different than what's being reported in the media. So thank you, Andrew. Introduce yourself, and let's talk about some of the Airbnbs, VRBOs.
Yeah, for sure. So my name is Andrew Bang. I've been investing in real estate since 2005. I bought a piece of land out in Maricopa. I flipped that piece of land, and with that, I used that to buy 3 rentals. And ever since then, I really haven't looked back. I started flipping homes in 2008. I was down there at the trustee auctions every day buying them, and then it kind of just continued along to where we are now, where I don't flip too much anymore. I buy rentals, but my main focus is on teaching, helping others, and lending. I have capital now that I lend out for investors who fix and flip and also buy rentals. But it was interesting. Me and Carrie were talking about the Airbnb market. I have some Airbnbs, and like her, I've heard the media and the news talk about, oh, the Airbnbs are down. I've had 100% occupancy since March, which is really rare. My Airbnb,
through all the shelter in place.
Yeah,
you're full.
100%. Yeah, and mine are up in Payson, which is kind of a, get out of the Phoenix Valley into a little cooler weather, a vacation spot. And when we had the shelter in place at the end of March, I had a lot of cancellations. But as soon as those canceled, within a week they were all booked up again. And so March, April, May, and now June, July, it's all 100% booked. I don't have a free weekend until the end of August right now.
Okay, so for everyone that's thinking that it's going to be easy to find a place to stay up in the high country, you may want to start planning your summer vacations right now, maybe even fall vacations.
Yeah, no, it's interesting because I had a friend that he buys rentals here in Phoenix, and he said the same thing, that his Airbnbs here in Phoenix, he has one in Peoria, he was like 80% booked up this last month. With everything that's going on, people are still, they want to get away from home, and I don't know if they feel Airbnb is a safer choice than a hotel, but they're getting booked up. It's
Are you seeing that same thing for the Airbnbs that are like in the metropolitan areas like Phoenix, Tucson? You're seeing the same thing, same trend?
Yeah, so the only ones is the Phoenix ones, and then Payson. Those are the 2 markets that I've talked to people that have them, and they're saying the same things that I'm seeing, and we're booked up. There's very few free days.
Awesome. Well, you've got an awesome PowerPoint presentation that you're going to go over. And by the way, if anyone does have questions for Andrew, he will list his contact information, but always feel free to put something in the comments or send me a private message or email, and I'm happy to connect you with Andrew.
Absolutely. Thank you so much, Carrie. Yeah, so how I'm looking at it now on my screen, I can't see the comments. So if anybody does have a question, Carrie, just interrupt me and then
I'll
I'll
do
be
that.
glad to answer any questions. Like she said, I math is something that I really enjoy doing, statistics. I used to be an accountant for about 6 years before I switched over to real estate. And so this presentation has a lot of equations, calculations, and I start off and I kind of with this, it's talking about the BRRRR strategy, which is an advanced real estate strategy for buying rentals. And it talks about four things. There's four keys that you want when you want a rental. You want cash flow, you want equity, you want appreciation, and then you want the tax breaks or depreciation. And so in this presentation, I'm going to go through each of those and show how it can be very complicated. There's a lot of equations out there, a lot of talk about how to calculate cash flow correctly, appreciation and equity. And I'm going to, at the beginning, it's going to seem vast and all this knowledge, but then I'm going to break it down step by step. And at the very end of this presentation, I have one Excel spreadsheet, which I will share with anybody who would like it. And all the equations that I'll go through will be on this one spreadsheet. So I go to a lot of conferences and a lot of these real estate investment seminars, and these experienced investors, they get up there and they get asked some of the same questions. And one of the most common question is, if I could go back in time to when I started investing, what would I change? And the answers are always very similar along these lines. I would flip less, buy more, and keep everything. Because once you get into this real estate investing, flipping is great. It's a rush. It can be a lot of fun, but it's a one-time income. You buy a property, you put all this time into it, and you get one paycheck at the end of the day, where rentals can generate income from you every single month. And there's a saying, if you can't earn money while you sleep, then you're going to work the rest of your life. So cash flow, we're going to talk about cash flow a lot today. The cash flow equation is a beautiful thing if you know how to do it correctly. I was reading a post on Bigger Pockets the other day, and the post was, how do I calculate cash flow? And all these people started chiming in. It was a really big thread. And there's all these experienced investors with different ways to calculate it. And there's a lot of myths out there. And when people say, oh, you can calculate it this way, and what's the right way to do it? So I've taken everything that I've done and experienced along with what I've learned to create my own equation for how I calculate cash flow. So in addition to that, I'm going to talk about the other three pillars. So there's four pillars of the rental. There's the cash flow, appreciation, equity, and depreciation. And I'll go through each one of those. So the BRRRR method. BRRRR stands for buy, rehab, rent, refinance, and repeat. So when you buy, you're looking for under market valued properties. Sometimes they're distressed. Most likely they are off market, like wholesale properties fit this model really well. You're using hard money to buy them. And then after you rehab them, rent it out, you refinance out of that hard money loan, and then you repeat the process. So finding the right property. If great deals are hard to find. And if they weren't, then everyone would be a successful investor. So you need to find a property that's undervalued or under market value. And there's three types of properties that sell for under market value. The first, the property is in distress. It needs renovations, it needs updating. Maybe there's exposed wiring and plumbing, it needs a new roof. It's very possible no one's living there. The second is the owner is in distress. The owner is in debt and needs to sell their property because they need the cash. And then the third is the owner wants or needs convenience. And that's a really popular one nowadays. So there's companies that target these three categories. For example, We Buy Ugly Homes. We Buy Ugly Homes are targeting the properties that are in distress. For the owner that's in debt, you see signs up all the time. I'll buy your house for cash. Stop foreclosure, get out of debt. I'll buy your home for cash. And the third one is, of course, Open Door, OfferPad, Zillow, these iBuyers who are pitching this don't sell your home the traditional way, we'll buy it directly. So they're offering that convenience. So rehab. So wholesale properties are off-market properties that people lock up under contract, and then they assign that contract to an investor who will go in and flip it. And so if you sign up for their property, get on their buyer's list, then you'll start getting properties on a daily basis, these off-market properties. And when I get these emails, and I'm sure a lot of you are already getting them, I see something that they talk about the rehab. They say rent ready for 10,000, full rehab for 30,000. There's 3 reasons why I don't like this. Number 1, I want to defer expenses for as long as possible once a renter is in this house. So right now is the time to get the new roof, the AC, to remodel everything. The second reason is I want to attract a tenant for the long term, and I want them to take good care of my property. So I want to be choosy about who rents it. And if I put a house on the market for rent that is fully renovated and shows really well, then I'll get a lot of people filling out applications, and I can be choosy about who rents that. The third is now is the time to put money in the property because I'm about to refinance and get that back out. If I don't put money in now, I won't see it for a long time. So there's 2 trains of thought when it comes to rehabbing a house. And there are successful investors on both sides, but they cannot be further apart from one another. So here's the first side. Be creative, be unique, use your imagination, try new ideas. They say things like help the rehab capture a story that the pictures can tell. Don't be afraid to question what others have done before you. When I get done with the house, I ask myself, would I want to bake some cookies in that kitchen? All right, so that's one side. And here's the other side when it comes to rehab. Copy, 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 and copy. Look for what others have done that has sold and copy it. Don't reinvent the wheel. Memorize this line: barely as nice as the home that just sold. So I've asked myself, where do I fall? Which side do I choose? And I came up with a question that I ponder every time I'm looking at a home to buy it. And it's a simple question. I say, do I want to fit in or do I want to stand out? How can I get the most money possible in the quickest amount of time? Do I want to fit in or do I want to stand out? So I look over the house, I look over the neighborhood. Do I want to fit in or do I want to stand out? Most of the time I'm fitting in. Why? I've never regretted the plain but clean and nice new kitchen, the beige walls, but I have regretted the blue kitchen I did once. I did regret building the treehouse in the back to try to stand out. But each home you look at, you want to ask yourself that question. All right, rehab estimate. So let me get my pen out here. There we go. This is just a quick way to look at a house and put some general numbers to it when it comes to renovating and repairing it. It's general rules of thumb to follow. So for these older houses, 1959 and older, it's about $40 a square foot to renovate it. And this is like a full cosmetic renovation. You're not moving any walls around, you're not doing any additions. And then as the home gets newer, it kind of goes up from there. So for example, if you have an 1800 square foot house, times that by $40 a square foot, and you're about $72,000 to renovate this house that was, let's say it was in 1935. But I'm getting a house that's in 2002, right? So I go 1,800 square feet, assuming it's the same square footage, times 25, and we're about $45,000 to renovate that. It's a quick, easy way to put some numbers on a house. So rent. So there's a few websites that I really like when it comes to renting a property. Rent-A-Meter and Padhawk are two that I use before I make an offer on a house. Before I walk through it, when I first get notified about it, I go to these websites, I get my number. All right, I know I can get $1,800 a month for this. Now, once I buy it, of course, I'm going to get my property manager to do a CMA on that to see what their opinion is and their evaluation. If I'm not using a property manager, I use this website, which is really nice. It has an app that goes along with it. So it's called inago.com. And I have my tenants download that app. And it's like a portal that connects us. And they pay their rent through the app. And their bank account's connected to it. My bank account's connected to it. So once they pay rent, it hits my account. And then they can also file like a repair requests. They can do that through the app. So it's a nice app that I use. Self-managing versus property manager versus hiring a team. I don't like managing my own properties. I do get a property manager. And I heard a saying once, have you ever tried to herd 30 cats together? That's similar to trying to manage 30 tenants. So that's why it's, that's no fun at all. So that's why I get a property manager to handle that part. I want my investments to be as passive as possible. And I saw this once and I thought it was really good. So you can manage up to 6 properties yourself before it becomes like a real part-time job. 6 to 60 rentals, you're going to hire a property manager for. But after you get over that 60 rental mark, you're making enough where you can hire your own team, and you're going to have an administrative assistant and someone doing maintenance. All right, so quick finance, just like that rehab, I want to be able to quickly find out how much I'm going to pay on my mortgage each year. That's the first expense I need to calculate. So there's a little trick that's called a rate factor. And for our current market situation, a rate factor of 6 means you can take any loan amount, times it by 6%, and you'll get your annual total of how much you'll pay in interest and principal. And that's based on about a 4.5% 30-year fully amortized loan. So for example, a $100,000 loan, times it by 6%, you're going to pay $6,000 total for that loan, for that mortgage, about $500 a month. And it's a sliding scale, 200,000, 300,000. So you could take any number you want. So for example, $239,000 is my loan. How much am I going to pay in principal and interest? I'm going to pay $1,195 or $14,000, about $14,000 annually. Financing, hard money. So hard money is considered a cash offer. And so for all of you that haven't done a hard money loan, hard money is a name for an asset-based loan, and investors use it to buy flips, and you can also use it to buy rentals. And it's when you go in and make someone a cash offer, you can use hard money, so you actually don't have to use all of your cash up. Now there's hard money loans are high interest, short-term mortgages. There's a national company that offers a 7.99% hard money loan. And their fees are just like this. This is an actual quote. 3 points, $500 for doc fees, $500 for appraisal, $1,000 for rehab inspections. I call this here 7.99% a teaser rate because when it comes to hard money loans, it's short term. What matters the most is the process and the additional fees, all these right here. So for example, Boomerang Capital only offers 1 point for their loans, but no doc fees, no appraisals, and no inspections. So if you have that loan for 6 months with the national company, you're paying a total of $9,000. But with a hard money lender that knows what they're doing and doesn't charge all these fees, it's about 30% less, it's $7,000. And the other thing is prepayment penalties. They don't call them prepayment penalties. What they say is minimum interest due. So this guy here, he has what's called a 6-month minimum interest due. So whether you sell that property in 2 weeks or 6 months, you're going to pay 6 months of interest. But with hard money lenders like Boomerang Capital that have no prepayment penalties, if you keep that for just 2 weeks, you're only going to pay, say, $100,000 loan is $500 plus your 1 point for loan origination. So it's only $1,500 total. So now you're comparing $9,000 to $1,500. So when you're looking at hard money loans, don't be fooled by these teaser rates. Look at it as a total cost of your property. All right, so how do you buy these distressed properties? How do you buy a property and not leave any money into it? Because that's what we want to get to. We want these properties to have 100% of all the money that we put into it. And if you're doing a conventional or FHA and buying off the MLS, that's not possible because both those have down payments. So what you do is you're buying these distressed properties using hard money to buy them, and then you're refinancing them into the conventional or FHA loan. So if you take your hard money loan, you have your purchase, and you have your rehab, a hard money loan will also give you the rehab funds. Your closing costs and payments will be everything that's into that property. If you can get this number right here, all these costs at 80% loan to value. Now some lenders are at 75%. With the coronavirus, they're tightening up a little bit, but there's still some that offer the 80% loan to value when you refinance into your rate and term. Then you're going to be 100% financed. So that purchase price, rehab, closing costs, and interest payments, I call that my all-in amount, my mortgage. And if that amount is 80% of the value of the property, once I'm done, then I'll be able to get all my money out of it. So let's do an example here. Let's put some real numbers to it. So closing costs are about 3%, and that's on both ends. My interest payments are 6%. If I hold the property for 6 months, it's 1% each month. So I'm at 9% of my purchase and rehab. So that's pretty easy. So we go purchase and rehab times 1.09 is going to give me my all-in mortgage. Divide that number by 80%. And that's the number that I need the property to appraise for in order to be 100% financed. So let's do an example. Here we go. So if you're buying a property for $80,000, and let's say, make it easy on myself. So I'm $20,000 for rehab. So I'm total $100,000 into that loan. My all-in mortgage is $109,000. Divide that by 80%, and I'm going to get 136,250. That's my ARV, or after repair value. That's what I need the house to be worth or appraise at. And then I'll be able to refinance my hard money loan and get everything out of it. So let's do another example here. I'm buying a property for $160,000. Let's say a little more rehab, $30,000. 190 times by 1.09. My all-in mortgage is 207,100. Divide that by 80%, 258,875. So this first property, because we're dealing with percentages, is going to be easier to find. Now, easier to find in Phoenix? No, not right now. Maybe in some rougher neighborhoods. But this 160 and 30 is going to be easier to find. But what you're going to be dealing with, if there's a wholesaler selling a property for 160, this is the purchase price, and it needs $30,000 of rehab, and you can sell it for 250. Well, then all these investors that flip homes are going to want that property because that's plenty of margin for a flip. But as me, as an investor that just wants to rent this out, I don't need to sell it for this price. I just need it to appraise for that price, which is much easier than finding a buyer. All right, so what do you want in a rental? But if you can make a wish list, of everything that you need in a rental, what would it include? Well, here's the first four. Annual cash flow, you want that to be making money. You want built-in equity. When you buy that property, you want equity already into it. You want it appreciating. You want all the tax breaks. You want it fully remodeled, worth full market value. You want it 100% financed, so no cash was left in. You want it on a low interest loan, multiple exit strategies, low re-rent repairs, and low turnover. Now that might seem hard to find, but if I could find all those items in one rental, taking all these characteristics, it would create what I would call the Burr golden egg, everything that I would want in a rental. Now my Burr golden egg's divided into four main sections, and I call it seed money. Seed money because it starts off small, then it grows and grows and grows. So my seed money has cash flow, equity, appreciation, and depreciation. So we need to calculate each of these, how much, and then how much will my rental be making after year 1, after year 5, and after year 10. So let's start with cash flow. And before I do that, Carrie, how are we doing on questions? Is there any questions that have come through?
We're good.
Okay. All right. Let's talk about one of these rules that I don't care for, and it involves cash flow, and it's called the 1% rule, a very popular rule that people talk about, and it pretty much says this. It's right here. When you're looking at a rental, you want the sales price to equal what you'd be 1% of what you'd be able to rent it out for. So a $100,000 property, I'd be able to rent it out for $1,000. Why do I not like this rule? Because when you use the 1% rule, you are adding another equation into the mix. And if I see this equation, I pass on the deal. I'm out. And it's called the cash on cash return. Cash on cash return. So let's look at an example here. So if you're buying the property for $100,000 and you're not getting any loans on it, so it's free and clear, the cash on cash return, what you're going to do is you're going to take your net income and you're going to divide it by how much money you have in the property. So if you're free and clear, you paid $100,000 for that property. And so your return on investment is 7.6%, which isn't bad. You know, it's not a bad investment, and that accounts for expenses. So let's say you got a mortgage on a traditional mortgage and you had to put 20% down. So because of that, my mortgage is going to take into my income, and I'm only making $3,700 annually on that property, but I still had to get $20,000 to buy it. You divide those two and you get 18.5% right there. So what if I could get this property financed for 100% and not leave anything into it? Now my mortgage would be a little more, so it'd cut into my income, but I have $2,400 divided by 0. You take any number divided by 0, and your calculator will tell you air. I love to buy air homes. I love to buy a home where it airs when it comes to my cash on cash return, because that means I have no money into that deal and I'm just making money without putting anything into it. Now I wouldn't be able to buy this property for $100,000. I'd buy the neighbor's distressed property for $60,000. I'd put $20,000 into it, refinance it, you know, at $85,000 or so. And that's how you do that. All right, the cash flow myth. Now I see this one a lot as well when I'm looking at these wholesale properties. The wholesaler will say, all right, your PITI for this property is $1,200, right? And the rental income is $12.75. So how much are you going to make on this property? Well, I'm going to make $75 a month on this property. And that is a myth, because you're not accounting for any expenses outside of this PITI, which is principal, interest, taxes, and insurance. So what happens when the renter stops paying rent or is late? What happens when the AC unit breaks, or you need a new roof, or there's a leak in the bathroom, or it needs landscaping update, whatever it is, all these things, the HOA you're not accounting for, utilities that the owner has to pay. Well, what happens is that you're not making $75 a month anymore, you're losing money. And as those expenses add up, you are losing more and more money. Sometimes you don't even realize it because they're in deferred expenses. So what are all the expenses that go into a rental? We need to list all of these out. So let's start with some of the obvious ones. There's taxes, there's insurance, and there's repairs. Now, repairs I break down into 3 categories. I call them, there's ongoing maintenance, capital expenditures, and move in, move outs. Now, capital expenditures are your big items like your roof and your AC, the appliances. And then, ongoing maintenance. And then every time somebody moves out, you're going to have to, there's always a few things you got to do, and that the security deposit doesn't cover. Vacancy is a big one. Loss of rents, late rents, evictions. And once you get into evictions, there's a whole number of things: attorney, court costs. You got to serve them notice, get the sheriff's deputy out there. And then there's always some theft and damages. And these expenses just keep adding up. And there's so many expenses that go on with a rental. How do we account for each one of these? Well, let's take 2, and let's just account for the roof and evictions. So let's say it's just a shingle roof, 1,800 square foot house. You're about $8,000 to replace that, and you got to do it every 30 years or so. Okay. And then for the repairs, say every 5 years, you put about $500 of repairs into that roof. Well, if you divide that out to a yearly expense and a monthly expense, it's about $30 a month that you need to put aside for that roof. Evictions. So the same thing. Let's say you do 1 eviction. Averages out on a rental about once every 8 years, you'll need to do an eviction. And the eviction costs attorney fees, court costs, and then there's also a vacancy while people are not paying that rent. So if you divide that out yearly and monthly, you get about $45 a month. Well, guess what? You add those 2 things up, you're already at $75 a month. So in our little cash flow example, just on the roof and an eviction, it's going to be $75 a month, but we haven't accounted for any of these other expenses. So as I go through these, I'm looking at them, I see a pattern with these expenses. And I see 2 types of expenses. I see expenses that I have to pay whether someone is living in it or not. And it's these expenses here, like the insurance and taxes. Whether someone is renting it from me or not, I will have to pay those expenses. But on the other side, I have variable expenses. These are expenses I only have to pay when the property is rented out. For example, property manager, repairs, damages, vacancy, loss of rents. Those are things that will only occur once the property is rented out. So I need to account for both of these sides. I need something that is fixed and I need something that is variable. Well, I have a mortgage, whether someone is renting the property or not, I have to pay that mortgage every month. And my variable, what if my variable is rental income? I will only receive rental income if it's rented out. So if I take 30% away from my mortgage, I add 30% to my mortgage, it'll cover my fixed expenses. And if I take away 25% of my rental income, it will account for my variable expenses. So let's add those together, and we'll use the numbers from our cash flow myth. We're at $1,200 a month is our mortgage, and our rent is $1,275. We need to put those into yearly numbers. 30%, 25%, add it to the mortgage, subtract it from the rent, and we get our adjusted expenses. And our cash flow on that property is negative $7,245 a month in actual and deferred expenses. So let's look at another scenario. This time, let's start with our total mortgage. Remember our rate factor? We need to get our yearly number for that mortgage. So we're going to times this number by 0.06. And we're going to get $12,459. And this one's easy. Just times $1,800 by 12 months. And we get our total.
So Andrew, let me just stop you for a second.
Sure.
So you're going through a lot of numbers, a lot of formulas, a lot of that stuff. So if someone is interested in doing this, are you able to help walk that investor through this whole process? Because I think a lot of people think it's kind of easy to do this, and you're making it quite clear that to actually be profitable and achieve your goal on the other side, that there's a lot of thought that goes into evaluating everything. So you can help if somebody wants to call you after this is all over and have you walk scenarios with them.
Yeah.
Will you do that?
Absolutely. Yeah. So I'm showing how I got these numbers, and I'm breaking everything down. At the end of the presentation, I have all these equations broken down into one Excel spreadsheet. And I will share that Excel spreadsheet with anybody who would like it. And my last slide is my contact information. And then I can also share all these PowerPoint slides. So at this point of the presentation, it's a whole lot of calculations, but I promise I'm going to break all these down so it's very simple. So you can look at any property, type in a few numbers into your Excel spreadsheet that I can share with you, and you'll know exactly how much that property will cash flow, how much equity, appreciation, depreciation you'll gain from that property, if you should buy it or if you should pass on it. Does that sound good, Carrie?
Perfect.
Right. So in this example here, I've picked these numbers for a reason. And I'm going to break it down right here. So we have our yearly, so mortgage times by 30, rent by 25, and I have my adjusted expenses and adjusted rent. And my cash flow, look at this, $3 for the year. So that's going to be our break even. You're pretty much breaking even. If you have a property with a $207,650 loan on it, and you're making $1,800 a month in rent, you're going to break even on that property. So using that scenario there, it gives us two very important numbers. It gives us our break-even cash flow with these two numbers here. So we started out with this mess. Remember this, all these expenses? We broke it down into fixed and variable expenses, which equaled this big equation here. But now it gave us $1,800 divided by 207,650, a break-even cash flow variable. So with this variable here, 0.00867, you can times that number by any mortgage, and it'll tell you exactly how much money you need to charge for rent to break even. And if you know how much you need to break even, then any amount of rent that you collect over that number would be your cash flow. So we started off with this mess and ended up with one number. So quick numbers. If I've got a mortgage for $80,000, I need to charge it anything. So my break-even number is $693. And it's just a sliding scale from there. 115,000, 170,000, 225,000. That's how much I need to charge for rent to break even. Anything above that would be your cash flow. So there's the break even, your cash flow number. Equity. 3 ways to gain equity in a house. You buy it low, you add value by doing rehab, repair, and remodel, or you pay down the mortgage. So, and if you got rent, the rent's going towards that. All right, so if you're buying a wholesale property or a direct to owner property, you're already buying it low and then you're doing the renovations. So you're already having equity in the house when you buy it. So the ARV is the after repair value or the full market value once the home is repaired. Minus that from the equity, from the mortgage, and that's going to be your equity, how much you have in the property. And if you are refinancing at 80% loan to value, that number is always going to be 20%. Paying down the mortgage. So on a 30-year fully amortized mortgage, that first year of payments, 25% of that goes towards your principal. So you take any mortgage, let's use our rate factor. 192,000 is my mortgage. Rate factor is 6, I'll be paying a total of $11,520 a year for that property. 25% of that is $2,880. That is how much will go towards paying my principal down. Now with the 30-year mortgage, every year that percentage of what goes to principal and what goes to interest changes. The principal goes up and the interest goes down. So in the second year, it's about 25.5%. Third year is about 26%, and then it goes up by about 1% to 2% each year. So if you start off with your built-in equity at $48,000, in your first year you're making $2,880. Well, that first year you have $50,880. By year 5, you have $64,000, and by year 10, you have $86,000 of equity in that property, and that's based on the $192,000 house. So our equity, 20% of ARV and 25% of the loan is going towards our equity. Appreciation. So I jumped on ARMLS. I should update this, but as January 2019 to January 2020, the Phoenix market had a median appreciation of 9.8%. To show in comparison, Denver and Houston, two other similar cities, had good appreciation, but not as good. The national average is 3.5%. So trying to calculate future appreciation is extremely difficult. So I like to use the national average when I'm looking at my properties and in judging how much they will appreciate. If it goes a lot more, like Phoenix has done, then great. It's just more money in my pocket. But to get a number, I'm going to use the national average. So if I have a starting value of 240,000, times it by 3.5%, my property will have appreciated $8,400 in that first year. Now with appreciation, year 2, I'm not starting with 240,000, I'm starting with 248,400 times 3.5%. And each year I will appreciate at a higher rate exponentially. So if I'm going to add up my annual appreciation with my annual equity and the starting equity I have in that property. So year 1, 59,000, year 5, 110,000, and year 10, 184,000 and change. If you're able to buy a rental that will increase in value by 184,000 in the next 10 years and not leave any money in it, how many would you buy? Well, you'd buy as many as you possibly could. All right, depreciation. Tax breaks. How do you calculate depreciation? So quick disclaimer, I was an accountant. I am not currently a CPA. These are, I'm going to say, general rules for each individual home. You should contact your accountant. But for depreciation, you're going to want to get your cost basis and your depreciable value. Your cost basis is what money have you put into the property. So you have your acquisition, costs and repairs. And then with depreciation, your depreciable value is the house. You are not allowed to depreciate the land. So you got to take away the land. And then your cost basis is about 80% of what the land is. So if you times your cost basis by 80%, you get your depreciable value. You can depreciate your property by 27.5 years and they'll give you your tax deduction on that property. So for example, 192,000 is my cost basis. 80% of that is the house, 20% is the land. So I need to take out the land. So I get my value here, my $153,600, divide it by 27 and a half years. And each year I'll be able to depreciate $5,585.45. So there's my seed money with all my equations, the perfect Burr egg. Here's some examples here of properties I recently purchased. It's difficult to find properties in Phoenix right now because of the price points and the rent that's goes along with those. So I've recently bought in Houston, but just for numbers' sake, let's look at these 3 properties.
Andrew, is there a place, areas of Arizona that you might consider looking at for rentals outside of the regular metros?
Yeah, I've seen properties in Tucson that are great. I saw a wholesale property in Eloy yesterday that one of the wholesalers put out. I think he wanted like $89,000 for it. It didn't need much repair, and I think he said you could get about $1,000 rent for it. So that one would cash flow, and you could get all your money out of that one. But there are cities around Arizona that's possible, and in Phoenix it's possible too. If you can find, you're going to be going for the lower valued homes, lower price points. Because I mean, you could buy a house in Gilbert. Say you bought a house in Gilbert for $300,000. It's probably only going to rent out for $1,800, $2,000 a month. So you'll have maybe a little bit of equity in the appreciation potential, but you're not going to be cash flowing at all in that property.
Have you been looking around? Like they just opened the 202. Now it's going through Levine. Have you seen any changes in that corridor?
I haven't, no. I still think the price points in those areas are still a little high to cash flow. It's tougher to find. There are deals out there, but they're just a little tougher to find. And you want a property, when I was talking about that golden egg, you want a property with low turnover. And when you're renting out properties in higher crime areas, it tends to have a higher turnover. But with those price points, a lot of times the price points are lower in those areas. So it's a give and take. But with this equation here, and these 3 would just use as examples. If you have a property where, like this one in Houston here, 176,000 is the purchase price, 40,000 a rehab with an ARV of 300,000, and I could rent it out for $2,450. The first question I'm going to ask myself on any home that I'm buying is, can I get 100% financing for this property? Which is another way of saying that is, will the ARV equal 80% of the refinance? Is the ARV 80% of the refinance mortgage? So remember this table here with this equation? That's the one I need to start out doing. So I'm going to take 1.09 times it by, so I'm going to get 176 and 40,000 is my total purchase price in rehab, times it by 1.09, and my mortgage is going to be $235,440. In order to get that mortgage, I needed to appraise at an 80%, divide that by 80%, and I need to get to appraise at $294,300. If I can get that number, I won't have any money left in that property. So at an ARV at 300,000, the answer is yes, I can get that. So calculating this one, how much cash flow and how much equity and depreciation would I get in this? So for cash flow, we're going to take our mortgage right here of $235,440 and times it by our variable of 867, which gives us $2,041.26. And if I can rent this out for $2,450 a month, that's a difference of $408 monthly. Times that by 12, and that gives me that number right there. So equity is pretty easy. We got it's worth $300,000, and I currently have $235,440 into it. So that's going to be 64,600. So how much equity will I get in a year from the principal pay down? Well, I need to get my rate factor here. So times that number by 0.06. Each year I'll be paying $14,126 in my mortgage. 25% of that is my principal, which is $35.32. Good. Appreciation. This property is worth $300,000 and it appreciates at the national average of 3.5%, which I doubt, but it'll be a lot more. Yeah, $10,000 and $10,500 in appreciation in the first year. And then my depreciable value, we're taking this number, 235,440 times by 80%. Divided by 27.5, that's where we got that one there. So at year one, I have $83,537 of value in that home of equity. By year 10, by year 5, and year 10, 283,000 with no money left in it. So you take all three properties, I'm about $700,000 at the year 10 while getting these tax breaks and cash flowing this amount each year without leaving any money into those properties. So I've taken all these formulas, just like I said, and put them into a nice, clean, simple spreadsheet. That's what it looks like there. So with that spreadsheet, you just say, all right, where's my, I put the purchase price, put in your rehab, how much you'll rent for each month, and how much it will be worth when it's all done, and everything else calculates. So for this example here of $85,000 and $20,000, excuse me, in rehab, I'm going to cash flow and I'm going to have money left over. I'll have no money in that property. So there it is. I'd love to share that spreadsheet with anybody who would like it. Here's my email here. You know, I started buying rentals in 2006. I bought 3 in Austin, Texas, and I haven't looked back. 2008 is when I started in Phoenix, flipping homes and buying rentals. And if anybody would like to talk about how to get started, how to get your clients started, I'd love to share this whole equation with all of you guys. And there's my contact there. Feel free to shoot me an email or give me a call, and we can grab lunch.
Could you talk a little bit about how if someone is a real estate agent, how they could add what you just showed to everybody as an investment, how they might be able to have even broader conversations with their prospects, as well as current, people that they've worked with in the past, to go back and say, I've added some additional things, tools to help you, get involved in investing.
Yeah. So, I mean, we have clients all the time that come to us as real estate agents and say, I want to buy a rental and I have cash to do that. And then going on the MLS, you're going to be showing them properties that are already at full price that are going to require them to put at least $20,000 down. So it's going to limit how much cash flow they make, and they're going to have to put down a lot of money into it. So by showing them this method, they're able to buy more properties, which means you'll get more commissions and they'll make more money and then trust your judgment more by doing this whole scenario.
When we've done classes in the past, you've talked about kind of helping the traditional real estate agent compete in the iBuyer market. And as you know, everyone knows in the Phoenix market, the iBuyers, they vanished for a short period of time and then they came straight back.
Yeah.
So how would a realtor maybe incorporate that into the conversation when they're going out there looking at a property that's, considering being listed, and being like the problem solver and all that?
Yeah. So, as realtor, being aware of what else is out there and having access to cash buyers yourself and hard money, then you'd be able to compete with the iBuyers. And because so many of these sellers, if you go into a listing appointment and the seller goes, well, why would I want to list with you when I can go get an offer from Open Door, OfferPad, and then I don't have to deal with all that mess? Well, if you have cash buyers of your own, you have your own cash buyers list, you can say, well, I can offer that service, or I can buy the house myself, because you know that you can call up me and get a hard money loan and buy that house for cash at the price that they're willing to sell it for. Because these iBuyers are not buying it at full market retail, they're buying it under it, sometimes 6 to 13% under what it would list for on the MLS.
I know I'm kind of putting you on the spot with this question, but what percentage of the homes that are available for sale in Phoenix do you think are actually on the MLS versus sitting inside the wholesale market?
Yeah, I think about 10%. I did this number once last year. I saw about, for every 18 homes that go on the MLS, there's about 20 wholesale properties. So what percentage was that? It was 6%. I don't know. It's not 10%. It's a lot less, but there's a lot of wholesale properties out there. So when you have someone that's looking for an investment property that doesn't care as much as the location. When I say location, they want to be in Gilbert in a zip code, but they're okay with 10 different subdivisions. There's a range there. Then wholesale properties would be perfect, because wholesale properties tend to sell between 70 and 80% of market value. You do have to have cash or hard money, and they're going to need a little repairs. But the benefit of that is you're going to get a property with equity in it. And your buyers that want to buy investment properties, they don't want to pay full market retail for it. They want to get a good deal. And the good deals are in the wholesale properties. So you need to have relationships with the wholesalers. You need to have a relationship with a hard money lender and understand these concepts. So when someone comes to you and say, I want to buy a rental, I want to buy a fixer upper. Well, the MLS just doesn't have those. There's so very few. And the ones that they do have, you are competing with thousands of other investors, where the wholesale properties, you're not competing with as many investors, especially if you're a realtor that understands that side of off-market properties.
So if somebody's interested in finding out more about the wholesale market, though, I remember talking with you in the past that you kind of can help people open the door to that world.
Absolutely. I have a list of active wholesalers in Phoenix. It's about 30 different companies. And I can email you that list, and you'll go to each of their websites or email them directly and say, I'd like to sign up on your buyers list. And then you give them your email, and then you'll start receiving properties from day one. I probably received 30 properties today from wholesalers and then the good deals go within a few hours, and then the okay deals, they drop the price if nobody buys them. But there's a lot of good deals out there, and there's a lot of people that are buying these properties to flip them and to keep them as buy and holds.
I've noticed just watching who on Facebook is taking a look at our presentation this afternoon. And there's a lot of people that, I'm originally from Minneapolis, so there's a lot of people from the Minnesota market that have jumped on here. Do you lend in Minnesota, or what states are you able to lend in and get involved in properties in?
Yeah, so there's 3 states that we lend in primarily. It's Texas, Colorado, and Arizona. That said, it's case by case on the other states. There's only a few states that we don't lend in that have certain laws, like California, Nevada. You need to have a brick, like Nevada, you need to have a brick and mortar building there in order to have a broker's license. But we've done loans in Florida and in Georgia, New Jersey. We do loans everywhere, but outside of those 3 states, that's our main focus. Texas, Colorado, and Arizona. Those are markets that we know really well. I know the Texas and Arizona markets really well, and so I can provide kind of the extra. When you're looking at a property, you want multiple eyes on it, multiple evaluations, and but we do lend in other states case by case.
Okay. I think we've covered the questions and whatnot. And I think we've talked about maybe doing in the future smaller, like breaking up some of these presentations down into smaller bits, because buying and flipping or buying and holding sounds a lot easier before they hear you talk. And so to break it down into smaller concepts and whatnot, maybe talk about wholesaling and all that kind of stuff, just to help people understand it. There's been, again, like we talked at the beginning of the presentations, there's this idea in the Phoenix market that people aren't lending, or the investment market or VRBOs and Airbnbs have kind of dried up. And I'm really glad that you helped steer us in a different direction to get some more clarity on what the market really is what's happening in the market. So we were talking about, Chicken Little. I don't think he entered or went into this market. Phoenix has continued to stay not just warm in the weather, but hot in the housing market. And so I know that your time is so valuable, and I just want to thank you for taking an hour and talking to people. And again, for anybody who's watching this, all these videos that I do are hosted on my YouTube channel, so you can find all these over there if you'd like to rewatch it, if you would like to share it with somebody. Andrew is an amazing asset to have. The feedback that I've gotten from previous live classes that I've done with him has been just over the top amazing. And so again, thank you so much, Andrew. I'm Carrie Sparks with Pioneer Title. Your Arizona title gal, and I just am so grateful that you spent some time watching and hopefully learning something today. My cell phone number is 602-715-5704. I am never too busy to help someone out with sales and marketing. Absolutely love what I do. If you do not have a current relationship with anyone at Pioneer Title, I'd love to be that person that you contact. So thank you to all my customers that are watching this and everybody else. Andrew, you have a beautiful day. Everyone else watching on Facebook and YouTube as well, have a wonderful day. And thank you so much for choosing Pioneer Title. We really appreciate you. Thank you.
All right.